That leads us to our talk of the tape as we look at yields there. Saw what they're doing. The SVB earthquake, what it means to your money, the markets in the days and weeks ahead. Let's ask our special guest, our headliner, Liz Ann Sonders, Chief Investment Strategist for Charles Schwab. It's good to see you on a very big couple of days here. How are you thinking about all this?
So it's hard to separate the effect of the jobs report on that change in expectations for a 50 basis point hike and obviously the SVB situation. I think it may have a bit more to do with the latter than the former, but I think this is clearly an example of something breaking. You know, the old adage of the Fed tightens until something breaks, and there's lags between changes in monetary policy, and the hiking campaign started a year ago, and this is one of them. Of course, as you all have been touching on, we don't know yet the contagion effect. There are unique circumstances around this bank with regard to the size of their investment portfolio, the fact that they weren't subject to liquidity coverage ratio. So it doesn't look like this. We can assume that there's serious contagion here, but it's also not surprising to see the industry getting hit from a market perspective, because things like bank runs are as much about psychology as they are things like liquidity and funding problems.
Sure. The word of the day seems to be, at least as it relates to what's happening with the banks, more idiosyncratic than systemic. But nonetheless, you mentioned the most important point of all, and that is something breaking. So are you worried at this moment about something else breaking if the Fed does what it says it still will?
So again, you've got long and variable lags. We're all familiar with that terminology, and that means that there is likely more impact coming from what has happened already. And I think that, you know, the Fed and Powell himself are perfectly aware of that. They talk quite often about the fact that inflation is inherently a lagging indicator and that the effects of changes in monetary policy are in the future. So they just have to assess as they go along. I'd be surprised if there weren't other things that break, maybe not directly related to the problems of SVB, but to some degree, we're already seeing breakage in terms of things like the weakness in the housing market, other areas that are clearly in recession within the economy, even if we're not in an overall recession. So I think there probably is more negative news. Now, whether the Fed steps in specifically with regard to something breaking this or additional things, you know, history is mixed on that subject. You know, when with the S&L crisis or the Orange County crisis, the Fed did not step in. The start of the Continental Illinois, they did not step in. In the early stages of the NASDAQ collapse in 2000, the Fed did not step in. So I think they're not likely to step in this situation until the point where it's either a serious system-wide problem or inflation has been combated sufficiently enough that they can look toward easier monetary policy.
You know what? I mean, maybe the difference in this case from the ones that you mentioned from out history is that they're the ones who are to blame here, right? I mean, you can draw a straight line from what they've done and how they've done it to what we're even talking about today. So I don't know if that has any influence whatsoever on what they may or may not do, but maybe this is a little more idiosyncratic too.
Yeah, I mean, look, we can all be armchair quarterbacks, and the Fed themselves, concede that they probably kept rates at the zero bound and the balance sheet at $9 trillion longer than they should have. But the bottom line is that's in history, and whether that was the big mistake, the Fed era, that probably was the case. But there's nothing we can do about that at this point. So now the Fed is in a position to do what they can, even though they might have gotten started a bit late. And, you know, a lot of people think that they're using the playbook from the 70s because inflation has been driven by the same things as occurred in the 70s. That's not the case. What they're trying to avoid are the fits and starts of monetary policy, sort of declaring victory with inflation having come down, easing policy, and then inflation rears its ugly head again. That happened a couple of times in the 70s, leading Volcker to have to come in and pull a Volcker.